Welcome back. Now, the South African Reserve Bank has made its strongest case yet for a sweeping monetary policy shift. The bank argues that lowering the inflation target would lower the cost of servicing government debt, with the Monetary Policy Committee finding a 3% target more attractive than its 4.5% midpoint. But what does a lower inflation target mean for the country's fiscal health and economic growth prospects? Ex-Treasury official Owen Willcox joins us now for greater perspective. Thank you so much for your time, Owen. Now, firstly, how has the current inflation target band worked for the country?
Well, it's been very good at bringing inflation down and also making inflation more predictable. We've seen a decline in the volatility of inflation, so it's become more manageable in a way, and that's been quite well sustained over the last 20 years.
Okay, more predictable. That's actually quite an interesting point that you make there. But just lay down then the mechanics of the benefits of a lower inflation target framework.
Well, the Reserve Bank is arguing a few different things. Firstly, they'd argue that there's a benefit that a lower inflation target will result in lower interest rates, and they would argue that lower real interest rates will lead to more investment. They're also arguing that debt service costs will be lower because the debt service costs, meaning that the amount that government pays, the amount of interest it pays on its own debt. So because interest rates will be lower in the economy, when government issues bonds, they will be able to pay lower interest rates, and debt service costs will be lower.
Yeah. Well, I mean, are there any risks or potential downside to the mechanisms and instruments then that the central bank would have to use in ensuring that inflation doesn't lift above 3%?
Well, the main mechanism they'd use is their normal mechanism for reducing inflation, which is higher real interest rates. So, and there is a risk. We know what the risk is. That if interest rates or real interest rates are higher, it's going to mean less economic growth, and it's going to mean less employment. So to move from an inflation target of 4.5% to 3%, we will have to sacrifice economic growth, and we will have to sacrifice employment.
That's a hard pill to swallow, sacrificing economic growth. But I mean, is that a point of short-term pain for longer-term gain? How do we approach that kind of conundrum in an economy that can't afford for its economic growth to be pushed down any further?
Well, I would agree with that. The modeling that the Reserve Bank has used shows that over time, and not in the short term, but over 3 or 4 years, we will see more economic growth from a lower inflation target. I would respond that we need to go back to 2017. We've already had this before, right? The central bank changed the inflation target from effectively 6% or lower than 6% to 4.5%. In 2017. And when they did that, the economy was stagnated. It wasn't only because of inflation targeting or a lower inflation target. There were many reasons for that. But we did end up in a position where the economy was stagnant, growth had effectively ceased, and there was a need for counter-cyclical policy to push the economy back into growth. So counter-cyclical policy meaning either the Treasury had to increase spending or the Reserve Bank had to drop interest rates. But as we know, the Treasury was not in a position to increase spending, and the Reserve Bank did not lower interest rates. And so we ended up in this position from 2017 to 2020, just as COVID started, that the economy was stagnant and there was very little employment growth.
I mean, just on that, because monetary and fiscal policy have to be in harmony. So what kind of base then would the fiscal landscape have to provide for the low inflation target to actually be effective?
Oh, that's a really good point. These two policies will interact with each other in quite substantial ways. So if you lower what we saw in 2017, and I would disagree with what the main argument from the Reserve Bank saying that if they lower the inflation target, they'll get lower interest rates and they'll get lower debt service costs. But what actually happened in 2017 was that it resulted in higher debt to GDP, and that's because unfortunately we have to do a little bit of maths in our head here, but the lower inflation target affects the debt side and the GDP side. So it resulted in debt service costs reduced, but not as much as the growth in GDP. So nominal GDP, the growth in nominal GDP fell by 150 basis points immediately, as it was designed to. But debt service costs fell only by about 50 basis points.
Yes.
And the result was that debt to GDP rose, and it became much harder for the Treasury to stabilize the debt to GDP ratio.
Yeah. And I'm also just wondering, could a lower inflation target filter through to inflation expectations? Because I know that also that's very, very critical.
That's correct. So that it would, and that's exactly what we have seen, though, that when we moved to the 4.5% target, there was an impact on inflation expectations. So the inflation expectations fell, and so part of the argument that the Reserve Bank is putting forward is that because inflation expectations have become a better guide to inflation, the costs of doing this will be less.
Yeah, I mean, also the goal of lowering the inflation target has been in the pipeline for a while now. Why has it taken so long to get the nuts and the bolts turning? I do understand that only now they are in advanced discussions.
I'm not 100% sure about that one, but I would guess that part of it is, as we said, you are going to have to sacrifice growth and employment. And I don't think that's a sacrifice that's worth making at the moment. Potentially, you could think about it if growth was much higher, but there's no... In the current situation where growth is so low, there needs to be some counter-cyclical boost to growth, and that can really only come from the central bank. And so it's not a good time to do it.
Yeah. All right. I hear your point on that. Well, thank you so much for your insights on this very, very important discussion, Owen. Really, really appreciate it. That was ex-Treasury official Owen Willcox.